Hi, good evening, ladies and gentlemen. Welcome and thank you for taking your time to join our webinar today. So I'm Chee, the moderator of this session. So I think we all know that the first quarter has been a challenging quarter. The conflict between Russia and Ukraine, the high inflation rate high, as well as the Chinese media delisting continue to dominate investor sentiment. So we think now is a good time to have an update on our managed portfolio and also to share our views on the market. So today we have invited Jerry to be our speaker for this session. So Jerry is the portfolio manager who managing the FSM managed portfolio with the team. So on top of that, he also managed the private mandate portfolio for our high net worth client. At the same time, he is also a CFA chart holder. So should you have any question regarding the market or our managed portfolio, please feel free to post a question in the Q&A at the bottom of this room. If you are joining through our YouTube live, you can also post it in the comment section. Our colleagues will facilitate the question to Jerry. So without further ado, let's welcome Jerry.
Hello, hi, good evening, everyone. Good evening, Chee. Thank you for the introduction. Can you hear me, Chee?
Maybe we can kickstart with the first question first, because before this webinar, we actually also collected some of the questions from the audience in advance. So to kickstart the session, maybe we can have Jerry to give us a quick update on the managed portfolio performance in 2021 and as well as the year-to-date performance, and what are the changes that have been made by the managed portfolio in this year so far. Jerry?
All right, sure. Before I think to share a bit on the performance and also the changes, right? I might want to share my screen. Maybe I will get Chee to help me to double confirm. Can you see my screen right now?
Yes, can.
Okay, sure. Yeah, first of all, I think thank you everyone for attending today's session. So like Chee mentioned just now, I think this session is really just in time to update everyone in terms of the current environment as we are coming to the end of first quarter, started the second quarter just a few days into April. We think that it is really a good time for us to share with everyone with the current portfolio strategy and also the current market environment, especially I think with the recent volatility in the global equity markets. I believe a lot of investors will start to be a little bit more panic and have a lot of concern regarding the outlook of the global equity market. Looking at the medias nowadays, right? Looking at the hit news titles, I think since beginning of this year, we've been seeing a lot of negative headlines. For example, the tightening in US side. Subsequently, we have the geopolitical risk. Russia invaded Ukraine, and then subsequently we see oil prices surge all the way from 70, 80 US dollar per barrel to as high as 130 US dollar per barrel before coming down to the current level of 90 plus to 100 US dollar per barrel. And subsequently in China, we also heard a lot of noises and a lot of news saying that potentially it could be a delisting threat on a Chinese stock that listed in US. And just happened couple of weeks ago, in the middle of March, a few states in China went into lockdown due to the COVID surge. So these are all the negative news that has really affected the overall market sentiment. If you look at the portfolio that we are managing in FSMOne, none of the portfolio being spared from the global sell-off. Our portfolio has been affected as well. But if you really compare the performance of the portfolio as a whole to some of these individual funds or even a single individual market, you can see that the drawdown within the portfolio is actually less resilient. It's actually more resilient compared to the global equity market. We are seeing lesser drawdown within the portfolio itself. Even we are looking at a more aggressive portfolio, the most aggressive portfolio, we are looking at a maximum drawdown this year of close to about 15%. Whereas if we really look into some of these individual markets, for example, China, the maximum drawdown, or China Tech, the maximum drawdown on a year-to-date basis actually close to about 20 plus to 30%. So I think that's also the beauty of investing into a portfolio, and has been emphasized multiple times over the years, saying that we should actually invest using a portfolio approach. One thing is about diversification to reduce the portfolio risk. The other thing is also to capture the opportunity within the global market. So I think just to share a little bit before I go into the performance table, right? What happened is that on a year-to-date basis, we have just rebalanced the portfolio in the middle of March. We are not able to rebalance the portfolio exactly at the bottom, because if you look at the bottom of the global equity market, just look at over the past 3 months, right, was exactly on 15th of March, before the strong rebound due to the supportive statement from the China Vice Premier Liu He. Market actually bottomed on 15th of March. But what happened is that we actually rebalanced our portfolio on 17th of March. We have been selling some of the fixed income exposure and buying the equity. So if you look at generally on average, we are bringing back our equity portion between the range of a 1.5 to about 5% level, depending on which portfolio that you're investing in. Yeah, definitely if you look at on a balanced portfolio, right, we're actually bringing in more equity exposure, because the year-to-date drop in the global equity markets, right, has caused the current allocation of the portfolio to deviate quite a bit from our intended level. So we have initiated a rebalancing, just happened on 17th of March, to bring back some of the equity allocation, meaning to say that this rebalancing, the action taken is that we have been selling in terms of our fixed income exposure, the local bond, mainly the local bond, and buying into mainly the global equity market, as well as our exposure in Asian high yield. So these are two particular segments that we have increased the allocation, just happened in the middle of March this year. And if I may go on further into the individual portfolio performance, especially on a year-to-date basis. And if you can take a look that on the conventional portfolio on the top there, aggressive portfolio last year, we registered about 7.1%, but I think on a year-to-date basis, the losses has actually wiped off most of the gains that we have obtained in the year of 2021. Year-to-date basis, we lost about 8.3%. For the aggressive portfolio, balanced portfolio, we dropped about 6.6%. Just to share a little bit that if you look at our portfolio itself, we have been positioning into, for example, China equity, which is our overweight position, and subsequently China technology. These are the two areas that we have quite a bit of our overweight position within the equity space. And within the fixed income space, we are actually overweighting on the Asian high yield. So none of these markets have performed well on a year-to-date basis. I think the sentiment continued to be very, very weak. Way before on the 15th of March, we continue to see very, very weak sentiment on a year-to-date basis. But what happened subsequently after 15th of March, we really see a turnaround in terms of sentiment. Global tech, the China tech as a whole rebounded more than 20 plus 30%. China equity also somehow rebounded about from 10% from the bottom level. So we see a turnaround in terms of sentiment, especially after the supportive statement from the Vice Premier of China, Liu He, mentioning that they are going to, the regulatory crackdown in China is likely to almost come to the end. And then they are rolling out some of the supportive measures for the local tech and also local property sector. So I think these are some of the key things that happened over the past couple of weeks that has caused, that's subsequently lead to a rebound in the global equity market. Similarly, if you look at the Islamic portfolio, right, you can see that year-to-date basis, Islamic portfolio seems to have a more significant drawdown. Now, Islamic portfolio year-to-date aggressive drop about 10.8%, balance drop about 6.3%. Just to share a little bit more with everyone, technically we know that for Islamic portfolio for Sharia compliance funds, right, they can't invest into financial sector, and majority of their whole, if you look at majority of the Islamic funds, equity funds, right, they will have slightly higher exposure into technology sector. So lucky or not, the technology sectors on a year-to-date basis, they're actually one of the worst performing sector due to the expectation of a higher interest rate moving forward. So the Islamic portfolio generally, it took a much hit in terms of a performance. It dropping about 10.8% from the aggressive portfolio, and also about 6.3% for the balanced portfolio. Yeah. So I think basically that's pretty much about the updates on the overall portfolio performance and also some of the action that we've taken. Just to share with everyone, the only action that we've taken on the year to date is that we have rebalanced the portfolio to increase our allocation in the equity market. The reason why we are not making more changes from the fund choices level and come to our geographical allocation is that our view for 2022 remain unchanged despite all the volatility, despite all the noises in the global equity market. Yeah, maybe Chee, you can goes on to look at if there's any questions from the forum, anything that probably our audience would like to know further, then we can actually address some of these questions.
Okay, sure. I think I saw some question because just now you mentioned about Chinese technology as one of the worst performing sector within the portfolio. So because in early of March as well, we saw some of the financial institutions like JP Morgan, they actually say that Chinese equities is uninvestable, but our managed portfolio is still hold on to this sector, China tech, Chinese, or even Hong Kong equities. So what is your views towards this segment, whether this region will rebound for this year or it take a longer time?
Okay, I think if you look at in terms of our Hong Kong tech or even our China exposure, right, throughout the year we have been receiving a lot of inquiry from clients asking us whether or not we are cutting or we are reducing our exposure into China equity, or are we cutting our exposure from the China tech exposure. So my answer is no, we are not cutting any exposure or reducing any exposure from China or China tech. In fact, like I mentioned just now, during this round of rebalancing, we have actually added a bit more exposure into this segment, China tech and also China equity exposure. And I think the thesis is pretty simple. I think at this point in time, right, we really can't find elsewhere that can offer us with such a cheap valuation and also decent fundamental. So if you look at the China equity as a whole, or particularly if you go into China tech, companies like Alibaba, Tencent, and so on, because of the regulatory crackdown, it has really bring down the prices significantly from the peak level. It dropped more than 50% from the peak level. Alibaba at one point, it dropped all the way until 70 US. If you look at the one that listed in US, $70 per share, all the way from 300 over US. So if you look at the fundamental itself, we don't see a significant change. Although if you look at from fundamental perspective, yes, the regulatory crackdown, there is certain impact to the fundamentals, but our view is that, like we have mentioned for quite some times in the past couple of months, that we think that this regulatory crackdown, the intention of the government is not really to destroy the company, but it's more on promoting a fair competition to protect consumer instead of just destroying all the tech giants. And we are not expecting them to disappear or being destroyed within 1 or 2 years period. So if you think about it, fundamentals remain very strong. Earnings growth for the next couple of years is still remain as a double-digit level. We are still expecting about 15-20% kind of earnings growth from the China tech sector as a whole, but prices has came down significantly just because that investors are not confident on the overall outlook, just because the sentiment is really, really weak. So at this point in time, we think it's really an opportunity for us to, in fact, add more exposure into this China tech and China equity. So like what I mentioned, we have just added exposure back in middle of March. And what I mentioned just now, again, to re-emphasize that if you look at the recent statement from Chinese regulators is that the vice premier have came out to mention that the regulatory crackdown for the tech company should be completed very, very soon. So it means that we are probably at the end of the tunnel. We are seeing some light at the end of the tunnel, and hopefully, over the next couple of quarters, when sentiment start to turn around, we will see investors will start to reprice some of these technology tech, especially the tech giants, because fundamentally they are really, really strong. There are some of these cash-rich company with a strong fundamentals and strong earnings growth. There's no way that the valuation can be as this low, just because of the sentiment. So I think to be a value investor, to really look at fundamentals, we really need to be a little bit more greedy when the street is fearful. Yeah, that's our view in terms of for the whole China equity and also China tech outlook.
So I think fundamental is really what the investor should be looking at. And we know the Chinese equity sell-off is mainly sentiment driven. So just now you also mentioned about in this year, the changes you made to our portfolio, which is to increase the Asian high yield exposure. So we know Asian high yield is mainly the exposure in Chinese property sectors. So we have an audience ask about, are there any potential stagflation that could pose greater credit risk to the exposure in non-investment grade paper for this Asian high yield?
I think if you look at Asian high yield, right, I think this is also one of the common questions that we have been receiving, because traditionally when investors invest into fixed income segment, right, do not expect to see such a significant drawdown. In fact, if you look at the drawdown within the Asian high yield space, since last year, I think they dropped more than 20 plus 30%. We see a maximum drawdown of 20 plus to 30%. And if you look at the valuation of this Asian high yield sector, right, we are seeing the yield to maturity, which yield to maturity, maybe I put it in a layman term, it means that on a more layman term, right, we call it the interest that you are going to receive if you are investing into this Asian high yield bond. On a normal period, right, yield to maturity for Asian high yield usually trading at about mid-single digit level. We are looking at about 6, 7, or even 8% level. But at this point in time, we are seeing double-digit yield to maturity. So in other words, it means that the valuation is really, really cheap at this point in time for Asian high yield. And I think all of us also aware what happened to, like I mentioned just now, the overall property sector in China. And that is the main cause to the drawdown of the overall Asian high yield sector. But looking at the current situation, right, if you just look at the Asian economy as a whole, last year itself, although we are seeing a recovery, but it's not a full economic recovery, because on and off, we are seeing here and there will be some lockdown, some we call it MCO, movement control orders from here and there in last year in 2021. So moving into 2022, we do expect a full economic recovery compared to last year. And right now we are seeing more and more borders reopening. I think South Korea just announced that they're going to reopen the borders, and even Japan has announced that they're going to reopen the borders. So Asia region as a whole, we are expecting a full economic recovery, and with full economic recovery and more borders reopening, I think potentially this could lead to a lower default rate for Asian high yield. And like I mentioned just now about the statement from the Vice Premier we heard on 15th of March, right? Not only that he touched on the tech sector, but at the same time, he also mentioned about rolling out supportive policy to the local property sector, because we know that with the current situation in China, with them still adopting a zero COVID policy, the economic growth as a whole will be affected due to the recent lockdown in Shenzhen, in Shanghai. Yeah, these are the incidents, these are the lockdown that's going to affect the overall growth in China in a 1 or 2 months period. So I think if you look at property sector as a whole, right, they actually contributed, or some of the property related sector, they actually contributed 20+% of the GDP in China. So we are expecting there will be more fiscal stimulus, and in fact, Liu He also mentioned that they are going to roll out a bit more supportive measures and policy to support the overall property sector. So if we look at what happened to Chinese property sector over the past couple of days, the property sector as a whole have rebounded significantly just over the past couple of days. If you look at companies like Evergrande and some of these property developers, the share prices have rebounded, and we believe that this positive sentiment, this turnaround in terms of the sentiment, is going to spill over to the Asian high yield sector. So I think this sum up the reason why we are still investing or still holding on to our Asian high yield segment. And in fact, right, if some of us are worrying about higher interest rate environment moving forward and so on, so if you look at on the fixed income space, right, if you're expecting interest rate to go up, the high yield segment, not only Asian high yield, but the high yield segment as a whole will be one of the action that we can consider. Usually we know that when interest rate is going up, we opt for short duration. But apart from short duration, high yield segment is also one of the segments that will be less impacted on a rising interest rate environment. So this is the key reason why at this point in time we are still slightly more positive on the overall Asian high yield segment.
Okay, so speaking about all these currently still underperformed fund in around this 1 year time, particularly the Chinese equities, all these fund, will you actually consider to top up or to average down on this fund to increase the exposure, given you say the valuation is cheap?
Yeah, I think that's what I have mentioned regarding the portfolio strategy. So what we have done is that we have rebalanced the portfolio in middle of March by reducing our fixed income exposure, because technically if you look at it, when equity went down and bond remained rather resilient, especially our local bond, Malaysia bond, right? So what happened is that when equity went down, in fact, just take an example, a 50-50 allocation portfolio, 50% equity and 50% fixed income, right? When equity went down significantly, more 20+%, some of the individual fund went down 20+%, it will actually brought down the overall asset allocation strategy. From 50-50, it potentially could be 45-55. So our fixed income exposure become higher. So what happened in middle of March is that we have actually sold some of our fixed income exposure. We reduce it back to our intended level and put it back into the equity market. So in fact, speaking about top up, we have actually added more equity exposure for our portfolio in somewhere middle of March. Yeah.
Okay, so just now you also mentioned about the valuation is much more cheaper in China now. So let's say on investor perspective, let's say currently I'm a balanced risk profile investor, but you talk about the valuation is now getting cheaper. So should I actually adjust my risk profile to more aggressive to increase the equity exposure?
Yeah, I think this is a very common questions that a lot of investors will ask. Meaning to say that investors tend to change their risk profile according to the market situation. I think this is not something that we recommend investors to do, because if you think about it, right, your risk profile shouldn't change based on market situation. Your risk profile should change based on your life situation. It's not about the market situation. Probably, if you think about it, some investors, they tend to be more aggressive when market is good. Oppositely, I think in fact, we should be more aggressive when market is bad. But if you think about investing in a portfolio approach, right, or you think about your own risk profile, right, by switching from balanced to aggressive is really a very risky move, because you are taking excessive risk in your portfolio, in your investment. So need to think about it is that if you are taking excessive risk in your portfolio, if let's say if market move against us and we continue to see a drawdown in the global equity market, what will happen is that investors will start to be very panicked, because they are taking risks that you are not comfortable with, because you are belongs to a balanced risk profile investor, and right now you are switching all into aggressive, meaning to say that in fact you should have 50-50 fixed income versus equity. Right now you are taking 90% equity exposure. So this is not right, as in when market move against you, market start to drop, you will start to be very panicked, because those kind of risk level is not comfortable to you. And that's where we will start to make irrational decision. That's where investors will start to be very panicked and start to worry about the outlook of the equity market. Suppose if they are imbalanced portfolio, they are looking at about 10% kind of a drawdown. But when they are in aggressive portfolio, they are looking at about 15, 16, 17% kind of a drawdown. If they are not comfortable with it, that's where they will start to make irrational decision. That's where they will start to thinking about selling their investment. So this is what we always advise clients, that don't make any changes in terms of your risk profile just purely because of the market environment. You should stick with your risk profile despite the market environment. And what you should actually do is that, considering if you have excess capital to deploy all those capital progressively to average down your cost of investment, not to change your profile from balanced category to an aggressive portfolio. Yeah.
Okay, so the moral of the story is that your risk profile shouldn't change according to the market condition, but should based on your own financial condition and take the risk that you can handle. So just now we've been talking about China, Chinese equity, Hong Kong. So let's talk about the US. So because last year we've been talking about US valuation is very high, that's why we underweight or being neutral on US exposure. But given the recent sell-off since the beginning of this year because of the hawkish central bank, so are they, particularly the tech fund, US tech fund, are they being attractive enough now, or there will be a further downside risk moving forward?
Yeah. Okay. I think speaking on the interest rate hike in US affecting the Nasdaq. If you look at history, if history is any guide, usually US equity market, they will drop. No, if it's just speaking from the interest rate, the rising interest rate environment. So if history is any guide, right, equity market will usually drop from the day one, the US Fed, the central bank, start mentioning about rising interest rate until the day that they implemented the first hike. So this is the period. Maybe I repeat again. The day that Fed mentioned about they are going to increase the interest rate until the first day they increase the interest rate, this is a period where we see generally equity market will drop. But if history is any guide, when Fed started the interest rate hike cycle until the end of the interest rate hike cycle, generally equity market will trend higher. And surprisingly, technology sector is actually one of the best performing market. If you think about in the previous rate hike cycle, so technology sector is actually one of the best performing market. So investors will start to ask about whether or not, given the current drawdown in a technology space, are we looking at a very, very attractive valuation for US tech? I mean, at one point it dropped, I think, close to 20% from the peak level. To be very honest, for US tech or for US equity at this point in time, no doubt that if you look at purely looking at the standalone valuation US equity market, it has came down quite a bit from the peak level. Valuation had came down, but at this point in time, what we think is that the valuation is still trading slightly at the higher end, especially if you put them side by side in comparison with most of the Asian and also China equity market. We are seeing really there's still a huge gap between US equity and also the rest of the Asian and China equity market. So that's why we are still at this point in time, we are still underweighting US equity. We are still underweighting the technologies, US technology sector. Where we are overweighting is actually China, Asia, Japan equity, and also particularly the China technology space. But if you're asking about the standalone US technology sector, what's the outlook? Our view is that we actually have a favorable view for the tech giants. Just to emphasize a bit, what we mentioned here is actually all the tech giants with strong earnings visibility. So this is something very important, because if you look at technology funds, right, we have kind of a different technology funds on our platform. There are funds that invested into tech giants. There are funds invested into some of these small to mid cap technology stock in US. So some of these small to mid cap technology stock, they don't really have a very strong fundamental, and they are more of a conceptual stock. It's more of futuristic kind of company. They're selling concept and so on. Fundamentally, they are not really strong enough, but they have a very strong concept to sell to the investor. So those stocks will take quite a bad hit, because when it comes to a tightening financial situation, right, investors will start to pull out their capital from stock that without strong fundamentals. But stock with strong earnings visibility, for example, most of the tech giants that we are seeing in US that have strong visibility, we believe that their long-term prospect is still remain very attractive because of the accelerated digital transformation. So when we are picking a US stock funds, right, or US technology funds, right, at this point in time, we are still have a positive view on, long-term positive view on those tech giants with strong earnings visibility, but not on those with small to mid cap tech stock with less earnings visibility or without a strong fundamentals. Yeah.
Okay, so in this monetary tightening environment, I think investors should put their focus more on the well-established mega cap that have a strong earning power, strong pricing power in the market. So another interesting question that I received from the audience is also about US, a recent very hot topic as well in the town, which is talking about the US recession. So we know that when the yield curve is being inverted, is often an indicator for recession in the near term. So what do you think about this, and what are the strategies that are being adopted by the managed portfolio to in this situation?
Okay. First of all, in our view, we don't expect any recession in short to mid term. Meaning to say that in the next 1 to 1.5 years, we don't expect any global recession. At this point in time, if we are looking into most of the global macro data, right, like it or not, if you look at the leading indicators, like PMI, sentiment data, all are pointing to an expansionary in terms of the economic activity. And in fact, if you look at in US, the labor market is pretty healthy and so on. So just looking at the global data perspective, the environment is pretty decent. But yes, of course, there are different school of thoughts looking at this inverted yield curve. Some is saying that when the 2 to 10 years yield curve inverted, it means that recession is coming, and potentially like what we have experienced in 2019. I think in the mid of 2019, somewhere in July, we have also experienced an inverted yield curve. So what happened is that 6 months later, I think it's about 6 months later, we did experience a recession. But try to think about it, take a step back and think about it, right? Back in I think somewhere in July or August 2019, anyone of us thought about COVID-19? Anyone of us thought about pandemic? This is something that's unexpected. And if you look at the recession that happened in 2020, it's driven by COVID-19. It's driven by the pandemic itself. So if you think about it, whether or not this inverted yield curve is indicating a recession, is still something arguable. In fact, I think what happened in late March this year, meaning to say last month, the US Fed, they have put up a research paper saying that 210 means that the 2 years and 10 years yield curve, right, might not be a very strong predicting tools to predict a recession. In fact, what investors you look at is actually on the shorter end, meaning to say something lesser than 2 years. For example, your 3 months and 2 years yield curve. And if you plot out the 3 months and 3 months and also 2 years yield curve, is still very steep. It's not indicating any recession at this point in time. So for our portfolio at this point in time, we are not going to position for any recession, and we don't expect any recession in the next 1 to 1.5 years.
Okay, so basically that's about US equities, because we know the yield curve is only serving as an indicator. So and history has proven that in between the yield curve inverted and until really a recession happened, there's still a plenty of time. So we shouldn't really give up the upside potential because of the possibility. So if back to our home country, Malaysia, does our managed portfolio is having exposure into Malaysia equities, and what is your view on Malaysian small cap fund in particular?
Okay, I think in fact we like Malaysia equity. We are seeing opportunity within not just Malaysia, but ASEAN as a whole. Because if you look at ASEAN as a whole, most of the ASEAN fund, the sector that the funds manager are investing in are actually financial sector. And financial sector is the one that we like for the year of 2022. So I think in our portfolio, you see funds like Manulife ASEAN that position into the ASEAN region with a higher exposure into the financial sector. So ASEAN as a whole, we like it, particularly for Malaysia. We think that the outlook could be quite attractive. On a standalone basis, again, I got to emphasize, on a standalone basis, Malaysia equity, we like it so much because that we think the economy as a whole just started the full recovery, like I mentioned just now, for the whole Asia. Malaysia is part of it. Now we are just about to start a full recovery in terms of economic growth, and then we are just experiencing the borders reopening on 1st of April. Now we are seeing more tourist arrival and so on. So that's going to be one of the catalysts to drive the economic rebound. Like it or not, the recovery team, the financial sector will be those sectors that we like for year of 2022. But again, if you put Malaysia side by side with most of the Asian and China equity market, then the on a relative basis, they might not be as attractive as those regions that we are investing in. So at this point in time, although we like Malaysia equity, but we are still keeping a 5% overweight. And the other thing that we are also waiting to see more clarity is actually from the political front, because with the recent two state election that happened in the past couple of months, we have been seeing a strong voters, a strong back to voters back to the Barisan Nasional BN. So from a foreign investor point of view, they like it because it's indicate policy stability and more clarity from the policy direction and so on. So we have been seeing foreign inflow into Malaysia equity market and so on. So for Malaysia equity market, for investors who wanted to have some exposure on a standalone basis, yes, Malaysia equity is attractive. Particularly, we like funds with a recovery play. We like funds with exposure into financial sector. But on the portfolio level, that given that we need to consider, we only have limited capital. I only have 100% of my capital need to allocate across all these different markets. So when we put them side by side, that's where we will start to think about the upside potential, the valuation, and so on for this market. And that's where we came to a conclusion to have an underweight position for Malaysia equity.
Okay, understand. So when we invest in single fund and compared to when we invest in portfolio, we should adopt a very different strategy. Okay, so a friendly reminder to our audience, if you have any question, please feel free to post in our Q&A in the Zoom, or from the YouTube, you can also post a comment. Our colleague will facilitate the question to Jerry. So just now you mentioned about ASEAN is remain attractive. So if we talk about a larger region like in Asia, we know Japan is the largest developed country within the region. So what is the portfolio positioning about a Japanese equity?
I think at this point in time, we are still holding a neutral allocation for Japan. Initially, back in early last year, early 2021, we are actually overweighting Japanese equity. But somewhere in the first Q of last year or somewhere beginning of second Q of last year, we started to trim down a bit of our Japanese equity exposure. There are a few reasons. One of the key reasons is because there's a lack of Japanese equity fund. Only we have limited Japanese equity fund within our platform. And the other reason back in last year, the reason why we trimmed down our Japanese equity exposure is because of the slow vaccination rate in Japan. But subsequently, we see a pickup in the third Q and also fourth Q of last year. At this point in time, the allocation is actually still on the neutral level. We have not been increasing back our exposure to Japanese equity, but there's something in our pipeline that we are seeing a brighter outlook for Japanese equity moving forward, especially for the recovery that I mentioned just now for the whole Asian region. Because if you look at Japanese equity, Japanese economy, right, they are more export oriented. Yeah, so with a more export oriented economy, potentially they could benefit from a global recovery. Yeah.
Okay, so maybe we take some question to ask about our portfolio strategy. So there are one audience in the Zoom that asks about our decision-making process. How do we finalize our decision? How do we execute? And do we use a self-learning computer, this kind of like algo trading things in our decision-making process?
The answer is no, because we don't use any so-called algo or machine learning kind of algorithm to make investment decision. So investment decision is very much from human. We are the one that make the investment decision. So in IFAS, we have a big research team regionally. I think in total we have more than 30 analysts and portfolio managers regionally in Malaysia, Singapore, Hong Kong, China, and also in India. So each of these analysts, they are covering respective markets. So what happened is that how do we come to a conclusion to say this market to overweight, this market to underweight? A few factors that we're looking at. First will be the overall economic environment of the particular markets, the valuation itself, the earnings growth outlook of the respective equity market, because those are the things that we will analyze on. Because if we're looking at markets with a very poor earnings outlook, that's where we will start to underweight, or markets with a very expensive valuation. So those are the market that we will tend to have an underweight position. So that's more on a macro level and asset allocation level. But when it comes to fund selection level, then it will be split into two areas, where one, we are considering on most of the quantitative data, like for example, your expense ratio, your past performance, and then your volatility, your resiliency, and so on. The other one will be more on the strategy of the fund managers, and then cash holding is also something that very important, because at this point in time, if you are buying into equity fund that you think that the market is cheap, potentially you want to avoid funds with a substantial cash holding. So those are the things that we also will look at on a qualitative perspective.
Yeah, so there are still more human touch in the decision-making process. So maybe another follow-up question about portfolio strategy. So we're speaking about in the beginning of this year, you just rebalance the portfolio. So is there any threshold or criteria that you use to decide when should I rebalance the portfolio?
Mm. We don't have a hard rules to say that, oh, when it hit this, is going to trigger a rebalancing. So I think the first layer of thoughts is that we will actually analyze the overall markets. When we think that there's no significant change in terms of the fundamentals, but prices have moved a lot, be it up or down, prices have moved a lot. That's where we will start to look into the portfolio and see whether we should rebalance the portfolio. But there is some threshold that we are looking at. For example, in terms of intra-asset allocation, just look at between the asset class, fixed income and bond. When it move between 2 to 3%, that's where it will start to trigger us to look into the portfolio and think about whether or not we should rebalance the portfolio. Yeah.
I see. So it's still very flexible, depends on the market and also the portfolio itself. And there's no hard rules to say when I need to rebalance the portfolio. So we take another question on Zoom about another asset class, which is about REITs. So what are your thoughts about REITs investment? Is there any opportunity in coming near future, in near term?
Looking into REITs, I think there will be some opportunity, but you need to look into which sector they are investing, which sector of REITs they are going into. So if they are within a retail REITs, if they are within a data center REITs, I think these are the areas that potentially we can see some upside potential. But most of the commercial REITs, I think potentially because of the change in terms of our working behavior, we are seeing more and more work from home culture globally. Yeah, so those can be a headwinds for all those commercial REITs. So by investing into REITs, something very important is to look at the REITs exposure, the subsector exposure. And the other thing also to consider about investing into REITs is that we are in a rising interest rate environment, and like it or not, interest rate is going to go up in the next 2 to 3 years. So on a rising interest rate environment, REITs might not be doing as well as they did in the past. So these are some of the things that investors might want to consider if they are positioning into some of the REIT sector.
So REITs will also be impacted in rising interest rate environment. Yeah. So another question from our audience is regarding the geopolitical tension between Russia and Ukraine. We has been 1 month into this Russia invasion. So speaking about the adjustment to the portfolio, it seems like there is no major changes to the portfolio positioning. So would you like to talk more about this, or how do you view about this geopolitical tension?
To be very honest to everyone, first of all, we don't in the beginning, before the war happened, we don't expect a war to happen. That's our to be very honest to every one of you, that's our thoughts. Before the war happened, we never expect that Russia is going to invade Ukraine. That's my first point. Second point is that right after the war happened, technically, if you look at all those historical events, geopolitical events that happen, it tend to have short-term impact to the global equity market, because from the sentiment perspective, it's going to affect some investors will start to be panicked, start to sell some of their exposure. So from a sentiment perspective, definitely we will see certain impact. But when we make an investment decision, we need to ask ourselves whether or not this investment decision is purely because of sentiment, or we are making a decision because there's a change in fundamental. So look back to this Russia and Ukraine issue, we think that one of the regions that could potentially be hit is actually the European equity market. I think they're actually relying so much on the oil and gas energy from Russia. So this will be one of the segments that potentially will be hit quite a bit compared to the rest of the world. So at this point in time, we're actually having an underweight position in European equity. But the rest of our position, for example, our tech exposure, our China exposure, our Asia Japan exposure, we still remain our positive view. So that's the reason why we are not making any major changes to the portfolio. We have just rebalanced the portfolio back in middle of March to bring back some of the equity exposure, because within the intra-asset allocation, those geographical allocation, we have not changed any view towards each of this market. Let's think about it. There's a war in Russia and Ukraine. Is that affected your usage on Facebook? Is that affected your usage to look at some of these online apps? No, it hasn't. So if things that happen somewhere else that have not affect the fundamentals, the true fundamentals of all this company that we are investing in, what is the reason that we need to make a changes to the portfolio? So yeah, that's a key reason why we have not made any significant changes to the portfolio, because there's no change in terms of a view for the global equity markets in the next 6 month to 1 year period.
I see. So fundamentals should still be the things that investors should be focusing more on. So another interesting question from the ground is regarding one of the very popular investment product, which is about the exchange traded fund, the ETF. So there are some audience asking that in such a current situation, do you recommend, because the market is being very volatile, do you recommend invest in ETF more or the unit trust itself?
Yeah, I think by choosing between ETF and unit trust fund, it depends on which market you are entering. It depends on which market you are investing in. So for example, if you're asking me that, hey, I want to invest into Malaysia small cap, should I go into, or I want to invest into Malaysia equity market, should I go into ETF or should I go into funds? Definitely funds will perform way better compared to all the ETF. You just pick our recommended fund for Malaysia equity, be it the small to mid cap fund or the big cap fund. They have much decent performance compared to any ETF, any Malaysia ETF, Malaysia equity ETF. So it depends on which market they are entering. For example, if you are saying that I want to invest into a global payment sector, within a funds selection or within a funds universe, you don't really have a funds that invest into global payment sector. But within a ETF universe, there is such a as an exposure. So it really depends on which markets that you want to invest in. Whether we want to invest into ETF and also funds, it really depends on which market that you want to go in. And the other thing is also to think about the efficiency of those markets, like the one that I mentioned earlier on. The first example that I quoted, Malaysia equity market. We know that Malaysia equity market is an inefficient market. Investing into such inefficient market, there's no way the ETF can outperform most of the funds. Most of the time we see funds outperforming ETF. So for example, if you're investing into US equity, so that's where you see most of the time, very rare we see funds outperform S&P 500 by a significant margin. So in such a scenario, investor will think about, should I save some of these so-called management fees by investing into this passive ETF? So that could be one of the options that investor can consider if they are exploring into some of these efficient and also developed markets. ETF could be a better choice. Yeah.
I see. So it really depends on the market itself. So due to the time constraint, I think I will take the one last question because there are several audience actually asking about this. This is also a follow-up question on the previous question. I think Jerry can see this question coming up because in just a few months ago, our platform has launched the stock and ETF trading platform. So by any chance, do you see the portfolio will going to include ETF or even stock within their portfolio?
I would say ETF inclusion into the portfolio is something that in our planning, something that we are considering, not stock at this point in time, but we are considering that in the near future, potentially there could be some ETF being included into the portfolio, given that if you want to take some tactical allocation, I mentioned just now, if you want to go into global payment, if you want to go into green energy sector in China. So these are the sector that we have a positive view, but we don't have a funds that have such exposure. So for some of these tactical position, we actually considering to have some ETF into the portfolio in the near future, but not anytime soon. Something that in our planning, in our pipelines, that probably in the near future you will probably be seeing some ETF, 1 or 2 ETF within a portfolio.
I see. So this is really something that we can look forward to. So thank you, Jerry, for your very insightful sharing. So maybe to sum up the session, I think the key message that Jerry is trying to bring out is that in iFAST, we always position ourselves as long-term investor, that we really focus on the fundamental itself. So maybe we can see all these market headwind now, like the geopolitical tension or even the interest rate high, the recession as short-term noises. So like what our portfolio has positioned, we remain very positive on equity. So we even have a 1 week position in equities compared to last year. So given the recent market headwind, I don't think it's the time for us to be defensive. So a good news that I would like to share with our audience is that we are now offering 0% sales charge for our managed portfolio starting from tomorrow until 29th of April is the end of this month. So in view of this recent market volatility, we think that is indeed presented a very attractive entry opportunity for our client, whether it's build up your new position or to accumulate to average down your position within our managed portfolio. Therefore, do not miss out this golden opportunity, and you can find out more and purchase the managed portfolio on our platform. So maybe before I end this session, Jerry, do you have any last word or the advice for our audience, for our client that invest into our managed portfolio?
Yeah, I think probably just to share a little bit before we conclude today's session. If you think about it, people always say that you got to be greedy while others are fearful. But most of the time, we are greedy while others are greedy. We are fearful while others are fearful. We follow the headlines and so on. Try to think about it when it comes to investment. Most of the times, if you look at media headlines and so on, there will be plenty of reason for you to sell your equity exposure. And I think in the past, if you just look at the past 5 years period, we have not lack of any market noises. We have not lack of any market uncertainty. There will be uncertainty at every point in time. There will be a lot of market noises. Think about it in 2016. Let's think about 2016. What happened? We have Brexit. People say we should sell off all our European equity exposure. But what happened to if you look at European equity funds in the past 4-5 years performance? In 2017, we have our the ex-US President Donald Trump came in power. Then subsequently, we have trade war between US and China. We have the US hiking the interest rate in 2018. 2019, we heard about inverted yield curve. It's the same thing that we have heard this year. It's a few days ago. In the same year, in 2019, we have the heightened geopolitical risk between US and China, the trade war issue. Then move into 2020, unexpected COVID-19 pandemic. So in every year, we have different noises, we have different uncertainty. But what we need to do is to be clear on the objective of us putting in the money into the investment. Today, I'm investing for the next 5 years and 10 years. I'm investing for my retirement. I'm not taking this money out. I'm not taking emergency fund to invest. I'm not looking at the short-term volatility. What I need to do is really to be fearful while others are greedy, and be greedy while others are fearful. Right now, everyone is being very fearful on China markets, on the global equity market. People are worrying about recession and so on. And when there is uncertainty, when there is noises, that's where you have the investment opportunity. So I really want to share with everyone that like what Chee have just mentioned, right now is really not a time to be defensive, but I'm not advising you all to put in all your excess capital, one lump sum, into the portfolio or into any single fund. What you should do is actually to plan out your capital and deploy them progressively, not to put in one lump sum, because with the current situation, we don't expect market to have a V-shaped recovery that we have experienced in 2020. It's totally different environment. Equity market volatility will continue to be there. So what we need to do is really to plan out how to deploy your capital progressively, plan it out across a 3 months to 4 months period, or whenever equity market drop a 5 to 10%, you will start to deploy 15 to 20% of your capital. So this is the way to plan out for deploying your capital, not to put in one lump sum, because market volatility will continue to be there, especially with the current situation, rising interest rate, with the current situation of heightening geopolitical risk. Don't expect market to have a one straight line rally within the next 3 to 6 months.
Yeah, I think this is what I really agree with, like what Jerry has mentioned just now. the market crash narrative is always there in the market. You can see every day this person talk about the market is going to crash in near term. So market is not lacking this kind of narrative. So do we really need to stop investing because of these noises? This is what investors should really consider about. So at the same time, do invest according to your risk profile and ensure that you are not taking excessive risk. Like just now, the strategic mentioned by Jerry, which is to deploy your money by tranches, is a very good strategy to average down your cost, because you don't know when exactly is the peak or when exactly is the bottom. So what you can do is focus on the fundamental and accumulate a position when there is attractive opportunity. So if you still have any question regarding the managed portfolio or the market, please feel free to send in your queries to our email investhelp.my@fundsupermart.com. So once again, thank you everyone for dialing in this session today. Thank you, Jerry, for your insightful sharing. Yeah, have a good night.
Thank you everyone. See you.